means that super cap, mega cap, giant cap technology has literally been running the show and running your money. Is that going to change? Joining us now to help us figure out that answer, Susquehanna's co-head of derivative strategy, Chris Murphy. Just a tiny little question to start this segment, Chris, which is the entire stock market of the last 3 years over?
Hey, Brian. I think technology is still gonna have its day. But when we're looking at the options side of things, blue chip names like Nike, Disney, Starbucks, they've been major underperformers. Part of the reason for those stats that you just showed. So when we're tracking some of the more interesting first half of 2026 option trades, we're seeing a lot of willing to buy further weakness in Disney or Starbucks via put sales, or looking for the stock to finally start to rebound and rally and outperform when we see call spreads in Nike, and even in the most defensive of sectors in the staples. We're seeing early 2026 call spread buyers. Now, they're not necessarily saying, we're sure that the equal weight is going to bounce back. What they're saying is, given the underperformance over the last, year, 6 months, et cetera, we like the risk reward to these option plays in case the rest of the market does finally catch up to tech.
Yeah, and that's a huge if. And we've seen, Chris, some head fakes where you've had these moments where the AI stocks will go down, other things come back, people come on this network, they say, this is it. And then the AI stocks come back. It is a kind of like the Fed minutes at the top of the show. Do you find it to be a bit of a, not confusing time, but it's not clear how things are going to play out, to me at least?
Yeah. No, I mean, it's an exciting time. We like to look at probabilities. We know nothing is certain. So we're going to look at the payout of a call spread. For example, in the XLP call spread that I mentioned, do we think XLP's 100% to get back to its 2025 high in 2026? We have, no, of course not. Nothing's 100%. Do we like buying a 25% chance of that happening? We do. So I think the uncertainty, rotating in and out of sectors, trying to pick winners, that all lines up really well for defined risk option strategies.
Yeah, and what are you seeing or not seeing in option spreads, Chris, that could give you, because we're looking at a VIX at 14.5. It's effectively showing, I don't want to say no risk in the market, but very low. The VIX is actually just a measurement of options activity, not straight fear. What are you or not seeing in the options market that's any kind of a crystal ball or tea leaves or insert metaphor here for next year?
Well, first of all, yeah, the VIX is pretty low. That's because every sector is moving in different direction. But the low S&P volatility is pulling down volatility everywhere. So, one interesting, kind of observation would be we're seeing a clear increase in tail hedges in defensive sectors, almost the opposite of what we were just talking about if the defensive sectors finally actually catch up. But you're talking about utilities, healthcare, staples, et cetera. We know that midterm election years, we historically do often see at least one or two big sell-offs. Those tail puts in those defensive, typically low vol sectors are pretty cheap. It's once again, not a play on staples are definitely going to sell off, but it's a play on these options are very cheap on the downside tail. If markets sell off, correlations spike, the volatility of a low vol product like the staples is going to move up a lot more than the volatility of something that already has a high volatility level, like like a single stock or some kind of high flyer. So that's kind of one way to read through the tea leaves.
Do you care who the Fed chair is? Or at Susquehanna, you guys, to your point, you're into whatever happens, you're going to have the optionality, literally and figuratively, for any outcome.
Yeah, I mean, you could look at betting markets and you can see
Kevin
big
Hassett
swings.
at 46% on Kalshi.
Yeah, well, but when that moved a week or two ago dramatically back and forth, the market didn't really seem to react very much. And just the earlier comments about not too hot, not too cold, a lot of mixed signals. That's kind of business as usual for the market. So long as it's not too extreme in one direction, things can continue to chug along.